You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, welcome back to Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the Options Insider Radio Network. 13 programs on the old network, including many, well over 100, I believe 130 now, archived episodes of the old Volatility Views program. Where can you find all of that volatility action, volatility analysis, volatility education, volatility goodness, volatility interviews, all that fun stuff? Well, of course, you can find it on the mothership, the flagship, theoptionsinsider.com. Actually, I misspoke. Actually, 160 hours of volatility goodness. I just checked the most recent numbers. And, of course, you can find all of that on theoptionsinsider.com. Just do what I just did. Click on the Insider Radio Network tab, and it's all there for you, freely available for your downloading and streaming pleasure. And, of course, you can also find us iTunes, Stitcher, TuneIn, wherever you like to find your favorite audio programs. We're probably there, and if we're not, let us know. We'll make sure it's available for you on that platform. And if all that is too much work, just grab our mobile app in the iOS or the Google Play Store or even the Amazon App Store. That, of course, allows you to download, stream all of our shows continuously wherever you are, wherever you got signal on your phone. You can queue up a bunch of episodes. You can listen to them on a plane. You got a long flight to Europe or something. You can download a bunch of episodes and enjoy them throughout the entirety of the flight. No Wi-Fi or signal needed. Lots of cool stuff. And of course, you can send us your questions, your comments, your feedback via the app. We love to hear from you guys. And without further ado, let's kick it off. It's time for the Volatility Review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, welcome to the Volatility Review. This is indeed the portion of the program where we break down what was moving, what was shaking, what was lighting up the old tape this week. Bit of a truncated show this week. We got a lot of other moving parts kicking off on the network that we have to deal with. But of course, we want to make sure we get our volatility action in for the week. And it was quite an action-packed week. We are recording this, of course, on Friday, June 5th, for all of you playing the home games. Gives you some frame of reference. And as we're coming into today's show, not a heck of a lot really lighting it up from an overall market perspective. Of course, we had non-farms coming in this morning, and the market seems to kind of have shrugged off that report. Most of the major indices off fractionally on the day. Really nothing much to speak of there. Of course, the biggest movement coming to the downside in the realm of volatility. The VIX Cash is as some premium we saw built into the market yesterday, as well as whatever vestiges were left over to protect against non-farms, is now all coming out of the market as we head into the weekend here. Not a lot of people thinking they really need to hold a heck of a lot of vol here going into the weekend. Most of the VIX Cash, I should say, coming off about a quarter. The futures coming off as well. But, of course, today wasn't really the big action-packed driver day. It was earlier this week, in particular yesterday, Thursday, where we saw the lion's share of the action in the market, with the major indices, the S&P selling off over 1% at some points during the session. So a lot of action, a lot of pronounced activity, as you might expect. A lot of action, of course, in the VIX products as well. So let's just dive right into that as well. Yesterday was an extremely heavy day. We saw over 500,000 contracts. That's definitely the most robust day we've seen in some time out there in VIX land, of course, barring that really aberrant trade where we had our friend doing, I believe it was the 1x3 June-July swap, which totaled 1.08 million contracts. That day aside, yesterday was certainly one of the heaviest days we've seen in some time. Looking here until, back in the days of mid to late May, about the 19th or 20th, we saw a few 700,000 contracts days. And one 900,000 odd contract, of course, back around expiration. But aside from those, expiration blip aside, these are some of the heaviest days we've seen in quite some time. We saw a lot of, as you might imagine, VIX upside call buying yesterday. The big trade, actually, of the week, and certainly the big trade of the day yesterday, came in kind of a bit of, I guess you can call it a time stupid. We don't see a lot of stupids going up in VIX, let alone a spread across several months. This is exactly what we saw yesterday. It was the June-July 20 call stupid going up about 100,000 times at some variety of prices, but it seems like the lion's share of them going up at $1.26. Buying 100,000 of the June 20s, buying 100,000 of the July 20s. It was pretty much an upside festival there in the VIX options. Some of that coming off today, people unwinding a little bit of that protection, people not as concerned about needing the upside in the wake of the sell-off kind of being mitigated so far today. Also saw some weird, funky stuff going up today. A few 1x2s, one 1x2 out in July. We also saw a SEP 20-30 call spread going up about 10,000 times. I believe it was paper buying out there. So a lot of interesting stuff, but the big sizable stuff we saw this week certainly coming yesterday on the heels of that big sell-off and that crazy, crazy stupid going up out there. One of the larger contract trades we've seen since that big, crazy 1x3 swap out there recently. And now joining us on the old Volatility Views program, the Greasy Meatball himself, Mr. Mark Sebastian. Better late than never. Mr. Greasy Meatball, welcome to the Volatility Views program, sir.
Hey, good to be here. Glad I'm back. Sorry about my tardiness, but as you know, I like to be tardy for the party.
If you're not fashionably late, you wouldn't be you, sir.
Exactly. That's what I'm known for, is one, being fashionable, and two, being late.
Luckily, they go well together in a sentence. Well, we were just running down what we saw this week. Obviously, a lot of action, particularly yesterday. What in particular caught your eye out there in this past week from a vol perspective?
I would actually say that, right now what I'm watching is volatility just get compressed across multiple asset classes. Yesterday I was on a show called Option Block, and we had talked about oil vol. And if you look at the OVX, the Crude Oil Volatility Index, getting absolutely plastered. If you look at the volatility on stuff like, bonds, even though bonds are down big, volatility's in. Currency vol is in. Equity vol is in. I mean, it is just, today is an absolute dumpage of volatility, the volatility asset class.
That's why people love this show, for our technical terminology. A dumpage.
It is a massive dumpage of the asset class known as volatility.
Yeah, and I was talking about that at the top of the show. Not really a lot of people seeing a lot of reason post-sell-off, post-non-farms to really hold on to vol and pretty much any asset going into the weekend here. You're right. I'll borrow your term of dumpage, but that is certainly what we're seeing across the board here. Not a lot of love for pretty much premium or vol in any product out there today.
No, not at all.
We started off talking also about some of the pop yesterday, of course. The VIX futures briefly popping over the 15 handle as well. Nice sharp spike out there, of course. A lot of that coming off. We talked last week about were we going to see some hedging going into the non-farms number. Well, when the S&P sells off 1%, it kind of obfuscates everything else going on out there from a premium hedging perspective. Certainly vol was up. Certainly there was a lot of hedging activity going on. How much of that was directly related to the sell-off versus the non-farms, probably the lion's share of the former, but the exact percentage is a bit hard to suss out. Mark, did you get any inclination? Obviously, we're seeing stuff coming off today, so that perhaps being a bit of an indicator. But do you see any inclination going into today's number that people were at all concerned about it, or did yesterday's activity pretty much just wipe that out of everyone's mind?
Well, yesterday's activity was interesting in that, even relative to last Monday, when we saw kind of a decent-sized sell-off, VIX and VIX futures reacted much harder yesterday than they did on a couple of bigger sell-offs relative to yesterday. So I felt like the market actually was, did have some embedded fear going into this event. It was not feeling 100% confident about what was going to happen today. And really, we saw that this morning. The first reaction out of the news was to sell, 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 as my friend Jim Cramer would say. And we've since kind of bounced, where you've got kind of the NDX down a touch and the Dow down, S&P up a touch, and the RUT up a touch. So it's been interesting watching things bounce around.
Yeah, it's funny you mentioned that, because I kind of had the same inclination going into yesterday's activity. I was watching this and saying, we've seen sell-offs like this before, about the same approximate level. We didn't see this commensurate level of fear, you can call it, upside hedging activity, premium buying, whatever you want to call it. So you're right. It kind of had the feeling yesterday that there was more afoot, and you can maybe attribute some of that, at least, to the non-farms lurking on the heels there this Friday. So maybe we can chalk that up to non-farms perhaps becoming more of an event like they used to be than kind of were for the last year. Everyone's kind of just been shrugging that off and saying, yeah, non-farms, they don't do anything. Let's look to the next crisis in Europe, or whatever the case may be.
Yeah, I said on Bloomberg today that I felt like in the morning the market went, ah! And then they realized that it was more of a meh that had really come out today. And so we end up getting a meh reaction, if you will.
Yeah, they realized, wait a minute, it's a summer weekend. Let's just sell everything and go.
Yeah.
Forget about this panic. Let's just go on the boat and dump everything until Monday, to use your term, dumpage again. And speaking of things, of course, we saw yesterday the market selling off, VIX popping, VIX up, kind of lighting it up. Yesterday has kind of been our topic du jour on the show of late, doing 84,000 contracts. Today, of course, the market selling off a little bit, but not much, kind of really unched. But vol certainly selling off again, the dumpage coming in. So a VX up, not where the action is today, only doing about 6,000 contracts, even though it has been the volume leader so far here on the product. Looking at VXDN, which is kind of the polar opposite of that, the VX down, obviously not doing much today either. Only 6,000 contracts and change in the VX up, only 400 in the VIX down. The VX down really does not seem to be, shall we say, catching fire with the masses the way the VIX up is. And they knew that in the construction of it. That's why they were building in that basic fee to the VIX up to incentivize people to trade VIX down. So far, doesn't appear to be working. Mark, what's your take here about what we've been seeing in this product, how it performed yesterday? And we've talked recently about how it kind of hasn't really been living up to what they expected, but perhaps delivering other things. What are you seeing in these products so far this week?
Yeah, I mean, it continues to just do not what it was supposed to do. But like you said, it kind of acts like a semi-consistent future. But, the contango's explicit. That's all it really is. I'll be interested to see whether what it looks like long term, because I'm not sure I'm a huge believer in this thing really lasting it out. I hope they do. But, it's just the way it looks right now. This is not looking like the home run product they were hoping it would be.
No, leaving a lot of room in the landscape for some perhaps other volatility competitors to dive in and take the reins out there. And we'll see maybe if some of these other products, perhaps even in the realized realm, can come to fruition out there and do some stuff. Looking over at our friends over at Russell, the RVX getting a little bit of a bump of late. The hope and interest has increased dramatically. Again, that's percentage-wise. Still not a ton open out there, but it seems like there was a bit of a time spread. The July-Aug 20 time spread going up looks like about a whopping 30 times. So not a huge paper, but still more than we've seen out there of late. I know they're working on some other things behind the scenes to really get that thing kicking and burning and getting a lot more customers really to dive in to the product. Because you think on the surface, Mark, it kind of seemed like a no-brainer when they launched this that, hey, Russell, small caps by definition more volatile, a little bit more active than the large cap stuff. It should be a hot vol product. And yet I think except for that one time when we saw that really, really aberrant divergence between Russell Vol and the VIX, where people were spreading the two back and forth, aside from that, I guess people are really kind of playing the wait and see game with this product to kind of wait for another divergence there, and then they'll spread it all day. But trading it by itself doesn't seem like it's really caught on yet.
No, it does not. Not in the least bit at all. So, I mean, it's really, trading is not caught on any vol product except VIX. And, that's just the way it is. So, I mean, I don't know what to tell you. It is not as easy a space to get into as maybe a lot of these guys thought.
Yeah, it does seem like VIX has been a bit of a lightning in the bottle. It kind of just took off almost in spite of itself, and in spite of some of the limitations of it, and now it's lighting it up, and the universe around it, VXX and others, and now these new things like VXUP and VXDN are certainly lighting it up out there. Well, Mark, you mentioned earlier, and you were talking on that outlook we shan't mention, of course, Bloomberg about crude vol coming in light a lot these days. People saying, hey, what's going on? What's going on as you vacillate around this kind of 60 handle out there, that all important there. We talked a little bit on option block, worthy of discussing here again today for our Vol Views audience. A lot about what's going on out there. Of course, famously, our friends over there at Goldman talking up some downside in the ETFs out there, XLE and USO to be precise, saying those puts dramatically underpriced from a vol perspective. Let me see if I have the exact quote. Yes, they call it, quote, dangerous complacency. And they were saying the options market shows a dangerous level of complacency in oil and energy equities ahead of the OPEC meeting. We don't expect big news. We see volatility is likely given the imbalanced positioning and high trading volumes. Their analysts have also come out with a relatively aggressive downside price target of $45 a barrel. So Goldman is pretty much saying, hey, they're going to give back all the gains we've seen in crude by October, and everyone and their mother should be lighting up these puts and really buying them en masse because they're a steal at these vol levels. Mark, we talked about this a little bit yesterday. We kind of joked about Goldman wanting, or been known in the past, to talk up a position or two that they have. Some big downside put trades going up in XLE too, perhaps coincidentally with the release of this report. But c'est la vie, that aside, what's your take on this, the general concept of downside puts in XLE and USO being dramatically underpriced from a vol perspective?
I don't know if you saw my blog post from yesterday on the Option Pit website, but it was actually titled, "Sorry, Goldman, you're wrong about oil vol." And
what exactly were you trying to say there, sir? It's too subtle.
Well, my point was realized volatility has been somewhere between 31 and 29% over the last month. The OVX leading to yesterday was 38%. Oil, plenty expensive. XLE, it's got too much ExxonMobil and Chevron and some of these huge names to really catch a big volatility push. I'd be willing to buy the concept of maybe doing something in some of the oil names a lot more than I would in oil itself. And I think you agree with me, and we're not gonna, without kind of going the nefarious route. Never
say that I agree with you, sir. Don't put words in my mouth like that.
That report was a little mystifying. Like, you and I, and I think you tend to agree with me here that it just didn't make any sense that they thought vol was too high or vol was too low and that there was too much complacency. How do you look at a oil VIX number of 39% and say that that's complacent? Let's not forget that the OVX was like 15 for 3 years, and that none of this really means that none of this stuff is really cheap, and oil is on the way down, not on the way up in terms of volatility. I think, I went on Bloomberg today and talked about this. I think you're going to see the OVX closer to 25 than you will where it was yesterday, by July. And I think short strangles make a lot more sense than buying premium.
As loath as I am to say that I agree with you, sir, I do have to admit it in this case. It is kind of hard to make a logical argument. Goldman tried. I'll tip my hat to them for trying. But it is kind of hard when you look at it in the cold light of, like we like to do on this show, realized versus implied. The actual vol that's being exhibited out there, it doesn't warrant a lot more premium. You don't have to say, oh, we need to really lift this. You know, the realized is just out of sight. This thing's moving all over the place. We need more vol to be reflective of this. And, you know, their price target aside, I take price targets with like anyone's with a huge grain of salt because everyone's got a viewpoint on every product, and Goldman's is more relevant than the other. They can just put some more paper behind it. But whether they think where crude's going, I could care less about that. But really, their viewpoint in the paper seemed like they were trying to kind of, you know, well, people always make the allegations that these houses talk up their positions. And that could certainly be the case. I don't know that to be the case here, but that could certainly be the case, even though it's kind of on the nose that that's what they're trying to do. I give them probably a little bit more credit than that. But on the flip side, you know, there is also the talk that maybe perhaps they're trying to justify their analyst target with some downside options positioning as a result. Because if you buy their analyst target, and clearly they have to because they're at Goldman, then people should be gobbling up these puts like crazy. So maybe they're looking at it to be charitable to them. Maybe looking at it more of, hey, there's a huge underlying movement poised here in the near term in crude and the related products, you know, XLE and USO, and people are not taking advantage of that the way they should be. And maybe that's kind of the way they were framing it. That's a charitable reading. But yeah, perhaps I tend to agree with you. There really isn't a lot of actual empirical data to stand behind and say, hey, you should be buying these puts, other than maybe you're already long a ton of them and you want them to pop a little bit more than they are. That's my cynical reading, but hey, I've been doing this for a while, so I've merited, I've earned a little bit of cynicism. Speaking of cynicism, a lot of people are also cynical in the land of the rates market. Too bad Jared isn't here to defend himself. I'm sure he would have a lot to say on what's cooking right now in the macro rate policy land. He's been, as everyone, our listeners knows, he was a big champion of the Fed's going to move, and the Fed's going to move soon. In fact, he was a believer they might even move by the June meeting. I think that's pretty clearly and demonstrably off the table now. Most people even thinking, including the IMF, famously or perhaps infamously coming out yesterday. And Mark, we chatted about this a little bit again on the option block, but it's so relevant to what your bet is, you're wagering here. We have to bring it up here as well. Of course, IMF kind of out of character for them, really using stern language. Maybe the different firms and the regulators and others seem to be getting a little bit more strident these days, and perhaps this is an indication of this as well. IMF coming out and kind of almost waving their finger, chastising the Fed, if you will, and you don't really see that very often, saying they have really no case at all for raising this year, and if they do decide to raise, they're going to regret it, essentially. Almost a vague threat saying if you raise, you're going to regret it because you're going to look foolish because you're going to have to reverse yourself down the road. And as a result, you will cost yourself credibility as an institution. I'm paraphrasing. The full quotes are available for you there online, listeners. And also saying rising rates too soon could trigger a greater than expected tightening of financial conditions or a bout of financial instability, causing the economy to stall. So saying they could do a lot more damage than they could actually helping the economy. So a lot of very strenuous and strident language there from the IMF, which kind of surprised me. That in and of itself is interesting. We've been talking about vol, obviously, out there in the rates and treasury-related products being one of the few places, bonds, where there actually has been some signs of life out there. So that also is interesting from that perspective. And certainly, Mark, I think this makes you happy because this seems to make your stake wager all the more certain.
Oh yeah, I mean I do. I mean rates are down today. I mean there's definitely some movement in the back end of the curve. It's interesting watching. I think one of the good things that's happening is even as front months start to act like rates aren't going anywhere, we're seeing the back end of the curve, the 10-year and more importantly the 30-year really start to react like there eventually will be higher rates someday. So maybe a positive coming out of that is that there is, the curve is kind of setting itself up to be able to stomach a rate hike when things actually make some sense. Unlike what we had seen into the end of last year, where we had the Fed talking about raising rates and the 30-year bond, near all-time lows. If we see the 30-year back off, well above 3%, and the 10-year get above 2.5 in an orderly fashion, 2.5% yield, then we're maybe in a position to actually stomach rates moving. So, maybe there actually is something good coming out of all this, out of me being right, besides me being right, which is always good.
Well, that said, the number this morning may put a little bit of water on that fire for the no Fed movement this year. Of course, the non-farm numbers and just essentially just a little bit more aggressive. The Department of Labor numbers this morning, the jobs report number they reported coming in at 280,000 jobs. The consensus was 226,000. So that's a significant surprise to the upside, the biggest jump they've seen in that since 2013. So perhaps some people, and again, market being weighed on that a little bit, obviously not too much, as we said earlier at the top of the show, but still, people perhaps pointing to that if you are in the pro-raise camp, Mark, and they're saying, hey, look, here's some data. Fed's clearly going to act. So did today's number spook you at all? Are you still saying no raise?
No, I mean, we've seen a couple of these numbers in the past, and they've amounted to kind of nothing. So I don't see it. I think we need to see a lot more months like this before they start thinking about a September raise. So, no, I'm not particularly worried about that at all, to be honest.
Just trying to make that stake seem a little bit less certain for you.
No, I know, I know you are. I'm at some point I will be wrong, and then I'm worried the world might be too shocked.
Yes, a horrible day for all involved. Speaking of horrible days, we're going to close the book on that and get to a much brighter topic, because it gives you guys a chance to kind of chime in and join us on the program. You too can tell Mark when he's full of it. But we'll start things off, of course, by diving in to the volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody. Welcome to the volatility voicemail segment. This is, of course, a portion of the show where you guys get to take the reins, fire away with your questions, your comments, your concerns from a volatility perspective. Mark, seem to have a bit of a thematic volatility voicemail segment today. A lot of these questions seem to have centered in around a theme. At least we filtered up the ones that had the theme today of volatility skew. So I think we're going to get into some good skew questions. Got a question coming in here from Andy V, and he writes, hey, I heard a trader on a webinar mention investment skew, but I didn't get a chance to ask him what he meant. Are you familiar with this term? Does it differ from volatility skew? Is there such thing as trading skew as well? Well, Mr. Andy, good question there. We've discussed investment skew on this program many times. Just to clarify, it is indeed volatility skew. It is one of the iterations, the variations that volatility skew comes in, the flavors, if you will. And one of the most prominent ones, probably one of the ones you're going to encounter the most, particularly if you're an equity and index options trader. And it's kind of the phenomenon we've discussed here on the program before of the puts having a market volatility premium to them. People are always coming in to buy puts because they're long the market, et cetera, and they're long equities and they want to hedge, and the psychological factors, et cetera. We've laid that out before. And of course, to the upside, people are selling calls because they want to generate income for those portfolios and a lot of the other topics we've discussed before. So there are many fundamental factors at work here that create that shape that we call investment skew. And that's what our friend on the webinar you saw was referring to. As far as I'm concerned, there is no such thing as a trading skew. I'd imagine that would probably be investment skew, if anything. But there are, of course, other flavors of skew out there. We see that in the commodity products all the time. Some products have risk to the upside, so that skew is there, and the premium is there in the calls as opposed to the puts, and vice versa. Some exhibit premium to both sides, more of that typical volatility smile. There's a lot of different shapes out there, but investment skew probably the most prominent and certainly the one you're going to encounter, and that's the one your friend was talking about. Hey, Mark, maybe that was one of your webinars. You've been talking about investment skew lately?
Yeah, that's something I might talk about. Yeah, what I use investment skew is kind of talk about, the different iterations of it. So, I'll describe an investment skew as kind of the skew you'd see in a typical investor's portfolio where they're trying to buy puts and sell calls, and otherwise known as kind of a what's called a backward skew, stuff like that, or a forward skew, depending on what direction you're looking. And so yeah, that was probably something I would have said.
There you go. So someone writing in, they were mystified by your webinar, sir, writing into the Vol
Well,
View
you
show.
should be, because I purposely mystify them. When I do a webinar, actually, I've got mist machines that I come out to.
Yeah, you got the magic tricks. You got the 80s music. Who's that character in Arrested Development?
Lights.
The magician. Oh, yeah, the Job
Yeah.
with his final countdown music. I could see you doing that on your webinars. It actually might make for a fun webinar. I might suggest that for you. A little
thank you. Great
80s
idea.
rock backdrop while you're talking about Skew. I would certainly tune in for that. All right, maybe our friend Andy will tune in as well. All right, next question. Again, Skewpalooza seems like here today. I'm not sure if this happened by accident or that's what our editors filtered for us. Either way, we love thematic volatility voicemail blocks. And next up on the volatility voicemail, we have a question from Greased Lightning. I like the handle. He writes, or she writes, Mark mentioned on the most recent episode of Volatility Views that academics believe skew shouldn't exist. Why? Isn't it an undeniable fact of the marketplace? There is a clear volatility premium to puts and a discount to calls in most products. Mark, I believe he's actually referring to something you were mentioning we were discussing on the show last week, your kind of suggestion that academics still sometimes take a dim view of skew. So since that was your comment, I'll let you have pride of place here. Why do you think academics still think skew shouldn't exist?
Skew shouldn't exist. I mean, theoretically, no, but practically, yes. It's just like it's a supply and demand issue with skew. I think that's really what drives it. Another reason, there is a theoretical reason where it could exist, in that the same move on a lower, one of the arguments that's made is, if I'm looking at a 20 vol stock and it's $100, that means it moved, or let's just say a 16 vol stock and it's $100, that means it moves $1 a day. Well, if it drops 50% and then still moves $1 a day, its volatility is doubled. It's now a 32 vol stock. So there is an argument that as underlyings drop, their volatility naturally increases, and as underlying rally, their volatility naturally decreases. And so there is an argument that for skew that's another reason why it exists.
Yeah, Skewpalooza. I guess everyone's got skew on the brain today. Let's see how many more we can squeeze in here in our truncated episode here of Vol Views. We got one coming in from Tom M. He writes, hey, I have a question for Volatility Views regarding, surprise, surprise, VIX Skew. He writes, hello, volatility traders. I would like to suggest a discussion topic for the program. Why does VIX have a skew? VIX options prices are derived from VIX futures prices, which are at least theoretically derived from the implied volatility of at-the-money SPX options. SPX has a skew, but that is already baked into the price of VIX. Thanks to the revised formula. Mark, this is a topic you and I have kind of bandied about for a while here on the show. I think you kind of just hit on it with your last discussion topic there, that at the end of the day, all these products, skew itself, the reason it exists is essentially a factor. It's all a factor of paper flow, of order flow, of customer flow, essentially what the customers are up to. So if the customers weren't doing this activity on a regular basis, you wouldn't see these things become exhibited in the skew of the underlying. Skew is kind of really just an attempt in the model to try to predict or account for these practical activities that we're seeing in real life. And that's kind of why we were alluding to earlier on the last episode about why academics think it shouldn't really exist, because technically it's not really a modelable factor to use to make up a term. There really is more of a kind of a fudge we've added in after 1987 in the crash. People started saying, hey, wait a minute, these options aren't really performing the way they should in this environment. Something else is at work here. What is that? And that's kind of the fudge factor that became known as skew down the road. And that's kind of why we see it exhibiting in anything that kind of is a tradable product out here, including VIX. I kind of agree with you on the surface. You look at it and you say, well, VIX is kind of this derivative of a derivative. We can get into some of the implications of what you mentioned here about them being correct or not, what things are derived from what. But that aside, the actual product is a tradable product, and you're going to see whatever paper flow coming in. That's why we talked about all the products. Remember, we were talking about oil skew very recently on this show and how it was changing on a weekly basis almost. There was a bid to the upside. There was a bid to the downside. Goldman saying there should be a bid to the downside again, yet it isn't there. So these products are going to ebb and flow. The skews are going to ebb and flow based on what's going on out there from an order flow perspective. And VIX is no different than that. It's not insulated from those market forces. If you're going to see some sort of weird, crazy paper flow coming in for the calls, guess what's going to happen in the VIX calls? It's going to bid up those calls, regardless of what's going on in SPX, regardless of what's going on in the futures. If the order flow dictates it, then it must be in the marketplace. And you're right, Mark. I don't think academics like that answer sometimes, but it's the reality of the marketplace. But would you have anything to add here for our friend Tom, who wants to know why does VIX have a skew?
Well, yeah, I mean, it's again supply and demand, but the other piece is that VIX skew. If you turned it upside down, you'd basically have something that somewhat connects to S&P 500 skew. So it's really just an inverse of that. And Mark, I was sitting around, so not a ton to add. I think you've hit it, but I think that we need to come up with a new name instead of Skewpalooza, because Skewpalooza I feel like is a little overdone. So I've come up with some new ones. What do you think about Skewcella?
Are we gonna have some bands in the interim?
Burning Skew.
Oh.
Or South by South, or how about South by South Skew, or South by.
All of these are implying a musical or drug element to the program.
Well, what do you think Skewpalooza is? That's Lollapalooza.
Okay, so I guess we need to have some. You're saying we need to have some bands in the transitions. I could work on that. We can invite some bands into the studio here.
Yeah, or we could. Well, I could invite the Mini Metals.
Yes, get them back on the show.
Yeah, get them back on the show. Well, I'm trying to think of what else we could have. We could have those are about the only major things I can think of. I mean, all the other conventions are kind of boring. We could have the there's the adult video news convention. So we could call it the adult video skew convention.
I think before we go too far down that road, I think we'll put a cork on the Vol voicemail. Thanks for the questions, everybody. I'm sorry we got a little bit derailed, but good questions. Good skew AVN, whatever you want to call it, skewosity, for lack of a better word here. A lot of great questions. If we didn't get to them, don't worry. We read them all, we'll respond to them, and we'll certainly maybe feature you on an upcoming program. Meanwhile, it's time for us to keep on rolling. Right on into our final segment. It's time to break out the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, welcome to the crystal ball. Like the man said, this is the portion of the show where we attempt to divine what the vol gods, as fickle and whimsical as they may be, hold in store for us for the week to come. This time last week, we were kind of prognosticating more about non-farms and kind of what effect they were going to have on the marketplace. It seemed like they had a bit of a little effect, but it was kind of obscured by the massive sell-off that preceded it in the marketplace. So the effect not entirely determined, but certainly everything coming out this afternoon implies that at the very least there was a little bit held over through the number. Don't have such a big focal point for next week. So, Mr. Sebastian, what are you looking for in the week to come? You think we're going to have more kind of summer malaise, more gentle drifting to the downside, or perhaps will something occur to give us a little bit of a boost in the market again?
The summer VIX came rolling in across the SIBO.
This is why we need to have a truncated show today, listeners. Mark's in a singing mood.
So I just feel like I'm with you. I feel like we're in a day where the market's down and the VIX is down at the same time. And yeah, we had some news come out today. But when I see that combo, that almost always leads me to believe we're going to get some sort of near-term bounce. So I'm looking for a 1 to 2% move higher on Monday or Tuesday.
2%? Wow.
Well, I mean, Monday or Tuesday, collectively.
Collectively, I see.
I don't think did I say 2%? 2%'s overboard. Let's say a 1% rebound and maybe a 2% rebound on the week. How about that?
That's a little better. Of course, this is the crystal ball segment. We're supposed to prognosticate wildly and indeed recklessly, and you just did both of those. So
I'm
well
famous
done,
for both.
I take my hat off to you and your reckless prognostication as well as to your dumpage, sir. All right. Before we go too much farther down that weird road, that's going to do it for the Crystal Ball segment. It's also going to do it for this episode of Volatility Views. Like I said, a little bit shorter show today. But before we go, as always, Mr. Greasy Meatball, what's cooking in the land of the pit? Do you have any more webinars to befuddle and or mystify our listeners with?
We've got the boot camp starting on Tuesday. Go to optionpit.com/bootcamp to sign up. It's going to be really a pretty good. If you're interested in learning how really professionals trade volatility, this is the educational class for you. And tell you what, since you guys are all VolView people, use code 25_O F, and you can take $25 off. So it's only $222. The old 222, otherwise known as sum total 6.
Or a delicious breakfast at many diners. Definitely a good recommendation for our listeners. And I'm glad you gave them a promo code, because people who made it all the way to the end of this very bizarre episode of Volatility Views, they deserve a reward. They deserve something. And so there you go, get some deals on Marks. And Mark, now I know why you were predicting a 2% pop at the beginning of the week, because once people are done with your webinar, they're going to be out there slinging options like crazy, and they'll be driving the market to mad extremes. Perhaps even that 2% you so recklessly prognosticated about. Okay, let's go ahead, surf on over to Option Pit. Take advantage of that deal. You should get something for making it all the way through the episode. And on behalf of Mark and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. And of course, for sending in such great questions, Skewpalooza or not, we'll take them all. We don't just want Skew. It just happened to work out this way, but send them in, and whatever is floating around in your brain from a vol perspective, send us in. We'd love to hear from you guys. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.